Brad Williams, Frugal Finance. Yen versus gold price mismatch. We're going to throw in some stuff. If you've not taken any of the other courses, I probably will be speaking in foreign language. If you've taken the other courses, you'll understand, for example, the law of one price. And if you've taken the courses sequentially, then you'll certainly will. But if you haven't, you might want to go back, spend a little bit of money, take the courses sequentially. With that being said, the law of one price applies to the foreign exchange market as well as to other financial markets. And I've explained the law of one price previously. Parity. Arbitrage ensures that for any three currencies that are freely convertible in competitive market, it is enough to know the exchange rates between any two in order to determine the third. Thus, as we show, if you know that the yen price of the US dollar is yen 100, keep that in mind. Yen price of the US dollar is yen. So it looks like $1 equals 100 yen. And the yen price of the UK pound is yen 200. It follows by the law of one price that the dollar price of the pound is $2. To understand how arbitrage works in the foreign exchange market, it is helpful to start by considering the price of gold in different currencies. Suppose you know that the current dollar price of gold is $100 per ounce, and its price in yen is $10,000 per ounce. What would you expect the exchange rate to be between the dollar and the yen? Well, the law of one price implies that it should not matter which currency you use to pay for gold. Thus, the yen 10,000 price should be equivalent to $100. Why 10,000 divided by 100? Which implies that the dollar price of the yen must be 0.01 or 1 cent per yen. Suppose that the law of one price was violated, and the dollar price of the yen is 0.009 rather than 0.01. Suppose you currently have 10,000 in cash in the bank. Since by assumption, you can buy or sell gold either for yen 10,000 per ounce or for $100 per ounce, you can convert your $10,000 into 10,000 divided by 0.009 equals 1.1111 yen. You could use the yen to buy 111 ounces of gold. So it's 1.1 million divided by 10,000 yen per ounce, and sell the gold for dollars to receive 11,11111. All right? You would now have 11,100 less the transaction cost of buying and selling the gold in the yen. As long as these transactions cost are less than 11111, $1,111, it would pay to engage in arbitrage. Free money, risk-free, completely risk-free. In a perfect world, wouldn't that be nice? Wouldn't that be your job? Just going, all right, fat cat, baby. That'd be nice if we could arbitrage our life and make this kind of money. And then we could be hanging out on my yacht or your yacht or flying in your jet or what have you. Anyway, yellow means hard-coded. That means you put this information. Here's 10 grand. C26, 10 grand. Yen was at 1 cent. You get C26 equals 10,000 yen. You go to Japan. You take your $100 to an exchange place. They're going to give you 10,000 yen. You have $10,000 and it's trading at 0.009. Keep in mind, if this was only 100, it'd be 11111. So just multiply times. So now, instead of 10,000, you're going to gain a bunch. So now with this 0.09, you have this many yen. You can buy your 10,000 gold is now, you can transfer it over for 11,111. You're going to make 0.001 cent on your money. This type of transaction is called triangular arbitrage because it involves three assets, gold, dollar, and yen. Got that? So you need to be very keen. In other words, you need to be sharp. Say you're completely new to all this and you've gone to the movies and you've seen these on how Wall Street works, and you watch CNBC and they have these traders that are looking at all these different screens. So they have 6 different screens. Unless they're a genius and can remember all that information, They're looking at, for example, maybe they're looking at gold, dollar, and yen. That's their job. And they're going to look for variations. Well, in the old days, you could do that. With the advent of the computer, you as an individual can't act that fast. You can't type as fast as an algorithm can do this in multi-milliseconds. Arbitrage situations are absorbed in a blink. Why are we doing this? When you're looking at your screen and you go, well, there goes an arbitrage situation, or if you foresee a possible arbitrage situation, perhaps you could get ahead of the market. And if you do, pass on your secret, okay? So anyway, keep in mind, this is a lot of academia, and hence that's why it's a lesson, it's a course, so you can understand what's going on behind the scene. Now, let's look at the relations among the price of three different currencies, yen, dollar, and pounds. Suppose the US dollar price of the yen, again, is 0.01 per yen, or equivalent 100 yen to the dollar. What does that mean? You take your dollar to Japan and you need yen. You transfer your dollar over to yen. So you give them that $1. They're going to give you 100 yen. Now, I don't know what the currency is, but maybe 100 yen, the equivalent of our $1. So they're going to give you 100 yen. I haven't been to Japan. I've been to a lot of other places, but I'm sure $100 yen is just their equivalent $1. Price of the yen in terms of the British pound is half pence. You're going to have, well, it looks like British pound equals 0.005 to the yen, or equivalent to 200 to the pound. Well, all you're doing now is you're going to get twice as many yen because the British pound is 0.005. So now from these two exchange rates, we can determine that the US dollar price of the pound is $2. You understand that? Although it may not be immediately obvious, there are two ways to buy pounds for dollars. One way is indirectly through the yen market by first buying yen for dollars and then using the yen to buy pounds. Since by assumption, 1 pound costs yen 200 and yen 200 costs $2, this indirect way costs $2 per pound. Another way to buy pounds for dollars is just to do it directly. The direct purchase of pounds for dollars must cost the same as the indirect purchase of pounds for dollars because the law of one price. If it is violated, there will be an arbitrage opportunity that cannot persist for very long. To see how the force of arbitrage works, to uphold the law of one price in this example, let's look at what would happen if the price of the bond of the pound were 210 rather than 2. Suppose you walk into a bank in New York and you observe the following three exchanges. Yen 0.01 per yen, yen 200 per pound, and $2 per pound. Suppose that there is a window for exchanging dollar and yen, another for exchanging yen and pound, and a third window for exchanging dollar pounds. US dollar to the yen, 0.01 per yen, or equivalent to 100 yen to US dollar. Japanese yen to British pound is half pence, pound 0.005, or 200 yen to the pound. With these two exchange rates, the computed US dollar to pound is $2. 0.01 divided by 0.005 is equal to 2. You can possibly arbitrage currency if a mismatch occurs. You can buy yen for US dollars and US dollars to buy pounds. Since 1 pound costs yen 200 and yen 200 costs 200, pound cost is $2. If this method is mismatched, an arbitrage opportunity exists. So what if pound is 210 to US dollar? Remember, we were pretending there were three different windows. How about right here? We're going to, at the dollar yen window, we're going to convert $200 into yen 20,000. Here, at the second window, at the yen pound window, convert that 20,000 yen into 100 euro. Then at the number 3, the dollar pound window, we're going to convert that, remember that 100 euro? it's worth $2. So now we're going to take that $100, we're going to convert it into 210 US dollars. What a pound is 210 US dollars. And when we repeat this at the dollar yen window, we converted $200 US dollars into yen. Then we convert the 20,000 yen to 100 pounds. Then we convert the 100 pounds into $2.10. Isn't that the wonderful world of finance? Wouldn't it be nice if we could discover this on an 8 to 5 kind of day? You just walk in and say, oh, okay, I've got $1 million and I'm going to play arbitrage all day long. And then you leave and you have 5 million in your pocket. You only have to work 30 days. You only have to work a month, and hey, that's retirement. Anyway, in a real world, the law of one price pretty much is accurate, especially now with the advent of super fast computers. We just, as individuals, can't act that fast. The computers will recognize this within a 16th of a cent for the most part, unless you have a secret. And that's why it's a secret. And you've discovered arbitrage opportunities and someone hasn't, and they haven't programmed an algorithm. That's why you are sitting on your yacht trading, working only a couple hours a day. Hey, I'm saying there's nothing wrong with luck and being really smart. Brad Williams, Frugal Finance. Hey, comment, let me know.